Hi, it's Joe Mazumdar of Exploration Insights, and I'm at the Metals Investor Forum at the May 2023 edition in Vancouver. I'm with Heliostar Metals CEO, Charles Funk. Charles,
Thank you for having me.
thank you. So Heliostar started off, taking over a project in Alaska, and now you've I guess, changed tack, and now you're in Mexico with a major acquisition for a junior company, switching from exploration to potentially development with this Ana Paula asset in Mexico. Can you go a little bit in terms of why the change in tack and maybe why Ana Paula?
Yeah, so we're unique as a company in that we want to build a producing gold company. I think most other companies here at this conference, business models to disappear in 2 years. Ours is very different. And so we had Unger in Alaska, great advanced exploration project, but we're in a market that wasn't rewarding or funding advanced exploration with very few exceptions. And so that's the definition of insanity, going back to the well looking for a different outcome. We recognised that we could buy advanced, permitted, PFS level projects cheaper from both a cash and a dilution perspective than that discovery development phase.
Right.
So we went out last year and looked to sort of have our own agency to go and step forward on that long-term vision. So we bought Ana Paula.
I guess the only question I have is like retail. I mean, like as you sort of jumped the curve from the Lassonde curve from the exploration stage going to discovery, and now you've gone down to the other part of the dip, which would be the orphan period of an asset, because you picked it up from Argonaut, right?
Correct.
At a discount, and now you're looking to take it up the other part of the cycle where a lot of retail isn't there anymore. So how do you attract retail to this story specifically?
Good question. I think there's two parts of that. First of all, the Lassonde curve is an idealized concept of the perfect scenario that doesn't exist with very few examples. Separately, the speed at which we can move with this asset is incredible in the sense that it's got its open pit permits. It's got a decline 400 metres into it. It's got a huge amount of capital spent on it. That means that we can rescope it, which with our changed vision, I think we'll talk about, or we should. Feasibility next year, we could be pouring gold in 3 years. So that it can move very quickly because of that history. And then the retail attraction, I think, is the profitability of this. We can drill very wide, very high-grade holes. We've got some of that growth part left because the high-grade core can grow.
Right. So getting into the development, now you're switching. When the 2023, there was a feasibility study or a pre-feasibility study on this, which was the open pit. Who did that?
So that PFS is really a 2017 PFS done by a company called Alio.
Oh,
They viewed it as an open pit target. And we, despite the permit, despite that PFS, we see it as a high-grade underground, less technical risk, bring the high-grade ounces forward, lower capex. So technically simpler, more profitable scenario. That's why we decided to buy Ana Paula. In the vagaries of the exchange, we have to file an updated technical report.
oh.
So we put our name on that technical report with just
Upgraded the
updated
costs.
economics.
Oh, okay. Right.
Not because we wanted to, but because we had to.
Okay.
So we filed that open pit PFS, but no, underground is our focus, and that's what we're doing a rescope on this year for the next 6 months.
Okay, so how do you take Ana Paula, which I believe is a high-grade breccia pipe?
Correct.
Is that right?
Yes, at the core.
And convert it from an open pit to an underground.
So
what are the phases?
Yeah, so Ana Paula has this very high-grade core, a combination of structural and host rock we think controls that, and then there's very low-grade halo around it. And so the open pit scenario had to mine a lot of that low grade that was effectively marginal, and you needed a more technically risky recovery approach to make that pay for itself to get to the sweet high grade. Our view is when you've got intercepts that are 100 metres at 8 grams, 50 metres at 11 grams, consistent, wide, high grade zones, go underground, go straight into that high grade, bring that forward. So I think we've got 3 key levers that we'll focus on this year. The first is we think it can expand. The drilling was sort of getting out and getting bigger and bigger and bigger. With a resource lens, there's actually quite a few ounces that we can add in the high-grade panel. So we put the first of those drill results out, 53 metres at 11 grams.
I saw that. That was the top result on the top 10 that Miners Deck does on a weekly basis.
It's one of the, you talk about attraction. There's not too many deposits that can deliver 800-900 gram metre intercepts, and that's what this consistently will do. That'll feed a resource update. We're targeting 1 million high-grade ounces at the core. Because it's been open pit as well, there's no underground mine sequence. So by just doing that work, there's multiple zones of 10 gram plus material already defined in the ore body. If we bring that forward, that's huge for the economics. And then lastly, we're proposing a vanilla float and CIL circuit for recoveries. We've assumed the base case there, and we think we can improve on that as well. So that's what we're doing this year to rescope ahead of feasibility construction decision next year.
So, because I guess it's polymetallic, is that?
No, it's a pure gold. 2% of the economics is silver, which is probably what you're picking up on, but bulk of the economics is gold.
Okay. And so metallurgically, what do you produce? What are the products?
So we looked at a couple of options. We're going to produce doré in this model.
Okay. All right. And so you're metallurgically, how are you going to, like, what are the recoveries from the open pit on the lower grade stuff that you're hoping to get to with higher grade on the underground stuff?
Yeah, so they went down a path and got 85% recovery with a process called atmospheric oxidation, a chemical approach to dissolving the sulfides. That's, in our view, a bit risky and very high OPEX. Yeah. We didn't like that. We want to go back to being vanilla. If for no other reason, first-time mine builders will have to demonstrate the credibility, so keep it simple. And it's just more capital efficient to go that way. That means the standard optimizations for that approach, the grind size, the floating off carbon before the CIL circuit, haven't been done. So we've assumed the base case and we think we can generate some very strong economics. If we get better results, we can improve on that. It's sort of like free head grade for no extra capex. So I think there's nice upside for us that we'll deliver this year.
Okay, so the idea is you add value by sequencing the high grade panels better, lower upfront capital because it's underground versus open pit, and also metallurgically improve because now you're dealing only with the high grade component and not with the low grade component.
Correct, and then growth as well. So I think we can grow the panel to 1 million ounces itself. It's a 60 metre wide zone on average. It's a spectacular width.
So what would the mining method be? Because you say it's selective underground, but I mean, if it's big enough, is long hole open stoping?
Yeah, I'm calling long hole selective, where you can go in and choose where you mine in what order. No, it's not. So it will be select long hole open stope, fill that in, go and mine next to it. The most cost efficient. Yeah. We're talking over 3,000 ounces per vertical meter. This is going to be, and we put out that 53 meter intercept. Only one of those 57 samples in that intercept was below 2 grams. Right. This is exactly the kind of ore body that you want to be mining. Very forgiving, very high margin.
Okay. All right. And so what kind of catalysts should we expect? I know there's drilling results coming from the infill and program on the panels. What else should we expect over the next 6 to 12 months? Because you're talking about an accelerated development plan.
Correct. So the key catalysts are continued growth. We've returned some good results, or very good results, but I don't think they're the best we'll get. We'll do the mine sequencing work, which is huge for the economics, the met work by the end of the third quarter, and then the resource update by the end of November. I think we can lift the NPV into the sort of 400 to 600 million range. And you're not talking 2 or 3 years for that. In 6 months, we'll have done the work that can generate that. We're looking at something like 150 million capex is what we think is possible. And we'll do the work this year to show that. If we deliver those catalysts, this project's a lot more valuable, therefore our company's a lot more valuable.
Do you have a throughput already in your head as to what it would be?
Yeah, 2 to 2,500 tons per day.
Okay. And lastly, I mean, we've seen the Mexican mining reforms come out. How, if anything, does it impact your ideas, your plan?
Yeah, so
the Mexican mining reforms.
On the whole, Mexico's taking its turn to be more prohibitive for extractive industries, as happens in the US and Chile most recently. They're a net negative overall. Weirdly enough, or perversely, they make existing projects and permits more valuable. Underground mining is routinely being permitted in Mexico. We're going to modify the open pit permit to go underground in our vision. So it doesn't really impact us, despite overall, I think it's a negative for the industry.
Right. Okay, but your plan and your catalyst and that, nothing changes.
No, projects like ours become more attractive to the Mexican authorities.
And since your permits for an open pit footprint, your underground footprint should only fall within it.
Correct. So you go into the government saying we'd like to reduce our overall exposure. That's a much easier thing to get granted. The decline's permitted. The only thing we can't do is produce from that decline.
And Alio did that before?
Correct. So Alio was pushing full steam ahead as their development project. Unfortunately,
so why do they need a decline if they were open pit?
because it's open at depth. So to talk to growth, this resource is open. And so you've got
So
to
they
be
were
pretty,
doing that for drilling bays. And
it was an
drilling.
exploration decline
okay.
that was built at a production scale. This is infrastructure that's pretty great to have.
Okay, so does it get you right there?
So it's a 412 meters they got. Unfortunately for them, their operating assets in Nevada sent them to the wall. It's 800 meters to push that into the center of the ore body. You're talking only 5,000 a meter, 4 million plus contingency costs, 6 to 8
lower
total.
your drilling costs.
That's one of the reasons the capex is so low in our number, or potential capex is so low, is because it's very little money to get right into the heart of this.
When do you think that'll be done? The decline.
We could do it as part of the construction phase in early 2025, or what I'd prefer to do, and it's a function of market cap, is get aggressive and push that in late this year, early next year. If you tell me the gold price of my market cap, I'll tell you when I do that, Joe. But we'd like to be aggressive.
Right. Okay. Well, thank you very much. Charles Funk, CEO of Heliostar Metals, and that's me, Joe Mazumdar from Exploration Insights at the May 2023 edition of the Metals Investment Forum in Vancouver. Thank you, and I hope this was helpful. Cheers.